If you've got super, and let's be honest, most of us do, then what's about to happen on the 1st of July could either quietly grow your wealth or quietly cost you a serious amount of money. And the frustrating part, most Australians won't even realise it's happened until it's too late to do anything about it. 5 changes, 1 deadline. And the window to act is closing faster than you think. Stick around, because by the end of this video, you'll know exactly what's changing, what it means for your situation, and what you should be doing before June 30th to make sure you come out ahead. Look, super rules aren't exactly thrilling dinner conversation. I get it. But here's the thing. They are genuinely one of the most powerful wealth-building tools Australians have access to. And every time the rules shift, there are people who benefit massively and people who get caught sleeping. We're talking about changes to contribution caps, a brand new tax on larger balances, shifts to the age pension system, and a couple of strategic windows that are either open right now or slamming shut on July 1st. So let's break it all down. No jargon, no fluff, just what you actually need to know. All right, first up, and this one's a win for most people paying attention. From the 1st of July 2026, the concessional contributions cap is going up. We're moving from $30,000 per person per year to $32,500. That's an extra $2,500 you can now tip into super, whether that's through salary sacrifice, employer super, or personal deductible contributions, and have it taxed at just 15% instead of your normal marginal rate. Now, I know what you're thinking. $2,500, big deal. But run that out over 5 or 10 years with compounding investment returns on top, and it's a genuinely meaningful difference by the time you're ready to hang up the boots. If you're currently salary sacrificing, it's worth jumping online and checking your arrangement, because it won't automatically adjust to the new cap. You need to update it yourself. But here's the part most people completely miss. And this is urgent. If your total super balance was under $500,000 as of last 30 June, you might be sitting on unused concessional cap space from the past 5 years. These are called carry forward contributions, and they let you make a much larger contribution in a single year and claim a bigger tax deduction. The catch? Unused cap space expires after 5 years, which means any leftover room from the 2020 to 21 financial year disappears permanently on the 30th of June 2026. If you don't use it, gone. Can't get it back? Never. So here's what to do right now. Jump onto MyGov, head to the ATO section, click through to Super, and check your unused cap amounts. And if you're making personal contributions to claim a deduction, make sure you lodge a notice of intent with your super fund and get their written acknowledgement back. Otherwise, the ATO won't let you claim it. Easy step, but people skip it constantly. All right, that was change 1. And honestly, the next one could be even more useful if you're thinking about moving a lump sum into super, because the numbers are about to get bigger. Change 2 is about non-concessional contributions. That's money you've already paid tax on, going into super from your personal savings, maybe from selling an investment property, an inheritance, or just money you've been squirreling away. Currently, you can put in up to $120,000 per year. From 1st July, that jumps to $130,000. But the real opportunity here is what's called the bring forward rule, which lets you pull forward 3 years' worth of contributions into one hit. Right now, that's $360,000. After July 1st, it becomes $390,000. Here's where the timing actually matters and why I want you to pay close attention. If you trigger the bring forward rule before June 30th, you're locked into the old $360,000 limit. But if you wait until after July 1st, you get access to the full $390,000. Now get this, you can actually combine both windows. Contribute up to $120,000 before June 30th using this year's cap without triggering bring forward. Then after July 1st, use the full $390,000 bring forward on top. That's potentially $510,000 into super in a fairly tight window, all sheltered from tax on future earnings. That's a powerful strategy for the right person. Just keep in mind, you need to be under 75 and your total super balance needs to be under the relevant thresholds. This one really does warrant a conversation with an advisor to get the timing right. Quick one. Drop a comment below and let me know. Are you actively using salary sacrifice right now? Or is this something you've been meaning to sort out? Would love to know where people are at. All right, back into it. Change 3 affects people who are close to retirement or already there. The transfer balance cap, which is the maximum amount you can shift into the tax-free retirement phase of super, is going up from $2 million to $2.1 million on July 1st. Once money's in retirement phase, like inside an account-based pension, investment earnings are completely tax-free, 0%. Which is why getting as much across that line as possible is such a big deal. If your super balance is sitting somewhere around the $2 million mark and you haven't started your pension yet, there's a real case for waiting until after July 1st to pull the trigger so you can transfer that extra $100,000 into tax-free territory. Now, if your balance is well below that, this doesn't really move the needle for you. But if you're in that ballpark, even a few weeks of patience could mean an extra $100,000 working completely tax-free for the rest of your retirement. One thing worth knowing, if you've already started a pension in a previous year, you won't automatically get the full $100,000 increase. You'll only get a proportion based on how much unused cap space you have left. So it's not a blanket benefit. It depends on your personal situation. Now, the next change is the one that's generated the most conversation around the country. And if your super is heading north of $3 million, you're going to want to hear this clearly. This is the one that's had accountants and financial advisors flat out busy. From 1st July 2026, if your super balance goes above $3 million, the investment earnings on everything above that threshold get hit with an additional 15% tax. That effectively doubles the tax on that portion from 15% up to 30%. Now look, for the vast majority of Australians, this isn't something you need to lose sleep over. But if your balance is approaching that level, or you're a business owner or farmer with assets held in super, this changes the equation significantly. A few important things to understand here. It's not a tax on your whole balance, only on the portion above $3 million. So if you've got $3.5 million in super, the extra tax applies to that top $500,000, not the full amount. It captures everything inside super, whether it's in accumulation phase or already in an account-based pension. And there's a second threshold at $10 million where the tax rate climbs even further. The thresholds will eventually index to inflation, but not for a while, which means over time, more Australians will gradually be pulled into scope. If this is your situation, the conversation shifts to strategy. Where should assets sit? How should things be structured? Is there a case for moving certain investments outside of super? These aren't questions to wing. This is where proper advice earns its keep. The fifth change is a bit different. It's not technically a super rule, but it could directly affect what lands in your bank account each fortnight if you're on or heading towards the age pension. And it's quietly flown under the radar. Deeming rates. These are the rates Centrelink uses to estimate how much income your financial assets are earning, regardless of what they're actually returning, have been on the move. For several years, they were frozen at historically low levels to cushion pensioners through the cost of living crunch. That freeze ended on June 30th, 2025. Since then, they've been edging up. Most recently, from March 2026, the rates lifted again to 1.25% on assets below the threshold and 3.25% on assets above it. That's the second rise in 6 months. Why does this matter? Because Centrelink uses these deemed income figures in the income test to calculate your pension payment. Higher deeming rates means Centrelink assumes you're earning more, even if your actual returns are lower, and that can reduce your pension entitlement. For people sitting just inside pension eligibility, a small shift in deemed income can push them out of the part pension altogether. That's real money, potentially hundreds of dollars a fortnight. If retirement is on your radar within the next few years, deeming rates need to be part of your planning conversation, not an afterthought. So there it is. 5 changes, 1 deadline, and a bunch of decisions that could genuinely shape how comfortable your retirement looks. Here's your 30 June checklist before we wrap up. Check your unused carry-forward concessional contributions from 2020 to 21. They're gone permanently if you don't use them. Review whether making a non-concessional contribution this year before triggering bring forward makes sense for your situation. If your super is near the $2 million mark and you haven't started a pension, consider waiting until after July 1st to capture the higher transfer balance cap. If your balance is heading toward $3 million, talk to your accountant or advisor about Division 296 and whether your current structure still makes sense. And if you're expecting to receive even a part-age pension, factor rising deeming rates into your retirement income projections. Super is genuinely one of the best tools Australians have to build long-term wealth and fund a comfortable retirement. But it's only powerful if you're paying attention when the rules change. Don't leave it to the last week of June in a mad panic. The decisions you make in the next few weeks could have consequences that run for decades. If this video helped you get your head around what's coming, do us a favour and give it a thumbs up. It genuinely helps get this information in front of more Australians who need it. And if you're not subscribed yet, hit that button now. We cover super, retirement planning, and practical money strategies for everyday Australians, and there's a lot more coming. Thanks for watching, and go check those carry forward amounts. Seriously, do it today.